Peter sold the local rights for $7 billion. So if you could compound 50% faster, people don't understand what that means. You could be a good businessman, but not a great investor.
You talk about a concept called pitch and catch. I've never thought about it that way, but tell us what you did for Ray Dalio.
Well, no, I wrote this book, Money Master the Game, and I wrote it because in 2008, as you remember, the world melting down. But I was coaching Paul Tudor Jones at the time, one of the top 10 traders in the history of the world. This is a guy who in 1987 the stock market dropped 20% in one day, the largest still percentage drop in a day. He made 100% for his clients. Genius. So when this was all happening, I couldn't believe it. And I couldn't believe afterwards nothing was done, and that the punishment for the people that almost destroyed the financial system was give them more money. I don't have a lot of skills, but one skill I have is the ability to get to the best people, and I'm good at modeling. So let me interview the very best. So in preparation for those, like Ray Dalio is one of the greatest hedge fund traders in the history of the world. So I prepared for him, I think 3.5, 4 hours the night before. I prepared weeks before, but I went even deeper. I knew every part of what was going in. So I went in as typical. I'm supposed to have a 45-minute interview, and it went 3 hours. And the same thing happened with Jack Bogle. Jack Bogle actually wrote a quote that says, Tony Robbins came by for a 20-minute interview, and 3.5 hours later, it was the most piercing interview of my entire career. He'd say something, I knew what it was, and I could add some value back. We went back and forth. That's what I call pitch and catch. It built a great rapport, and we're good friends today because of it. But one of the questions I asked him at the time was, what is the single most important investment principle of all the things you've learned that people should know? And he said, Tony, that's a great question. I struggled with this for years, and I finally came up with what I call the holy grail of investing. And he said, Tony, if you can find 8 to 12 uncorrelated investments, you reduce your risk by 80% and you increase your upside. That's wild. Now that sounds wonderful on paper, but when you go to do it, it's something else. And then I was at the JP Morgan conference where you got to be a billionaire to go. And I'm one of the speakers, and Ray's right before me. And somebody asked him some questions and kind of led to a similar question, like what's most important to remember? And he said the Holy Grail, same thing. And every head in the world, which had not written a single note the entire day, dropped down and wrote it down. So it's like, I need to realize even sophisticated people miss this one. They may know it intellectually, but they got it. So then how do you do that? Like, it's hard because you say, okay, stocks and bonds aren't correlated usually. Stocks are going up, bonds are a different price point. That's usually the balance. But during tough times, they get aligned. Then I started studying history and saying, okay, your asset allocation, where you put your money at risk, small risk, larger risk, upsides, etc. So I said, well, what is the asset allocation for the most successful people in the world? Well, ultra wealthy people have 46% of their assets in private equity. Yeah, but that's hard to get into. And then I started doing the homework, and I found in the last 37 years, there isn't a single stock market in the world that has beat average private equity. Here's the real numbers. The S&P 500, that most people would invest in, or at the index, has gone up 10.7 over the last 37 years. It's pretty amazing, compounding. The average private equity, not these guys, has been 15.7. So if you could compound 50% faster, people don't understand what that means. If you put $1 million in the S&P 37 years ago and you never touched it, it's worth $42 million today. If you put $1 million in the same day, same amount of money in private equity, average private equity, it's worth $223 million today. How does the average person get that? There are things like a credit investor. The government doesn't give you access to all these investments. The best investments are reserved for people that already have money. It seems so unjust and unfair. I was squawking about it. I didn't do it, but somebody woke up in Congress. And last year, that's why I wrote the book. Last year, they came out with a new rule. Senate's got to confirm it this year. But the new rule is, look, you could get a lot of money by inheriting it. That doesn't mean you're a sophisticated investor. You could be a good businessman, but not a great investor. So why would we penalize people, say, if they have a certain amount of money? Let's give them a test to take. They can study for it. They understand it. That anyone can have access to this. So imagine the compounding value to get your financial future when you can do this. So I'm talking to this guy who's one of Paul Tudor Jones's associate partners before, and he broke off and started his own company. I'd helped him really grow his business quite a bit. And I was saying to him, private equity is great. And because of, guys like you and I, we have certain relationships and brand, and so we can get access to some of the best. But the amount you get, they're all sold out right away. It's so small that it wasn't going to alter my life in any way. So I was, saying, man, it's like, how did he get in there? It's just, the very best is already sold out. And he goes, Tony, you helped me so much. I got to tell you where I put most of my money. I said, where? He goes, there's this company in Houston, Texas. And I went, Houston? Not Singapore, London, New York, Connecticut, Houston? He goes, yeah. He said, they're off the beaten path, but they are brilliant. And here's what they've done. When you try to invest in private equity, you become what's called a limited partner. And as you know, you give them your money, and then they charge you 2% of your money, whether they make you money or not, and then they get 20% of the upside. And people are willing to do it because they're so successful. But it makes them very wealthy. If you look at the Forbes 400, you'll see which industry has the most billionaires. People think it's tech. It's not. They think it's real estate. It's not. They think it's entertainment. It's not. It's financial services. And it's specifically not hedge funds that go up and down. It's private equity. So I look at this and I'm like, okay, these guys are the masters of the universe and they're getting 2 and 20. He goes, Tony, they have a way for you not to try to get into a fund, but to own the fur. So think about, instead of betting on a horse, owning the racetrack. I'm like, you can do that? Some of the best companies in the world, $100 billion funds that have produced results that are incredible. So I went and I became a client, and then it turned out the founder of that company 20 years before it was a student of mine, like you, changed his whole life. And he's like, Tony, how do I get you involved? I said, I want to get involved. So I invested in the company. And then I wrote the book to let people know all these opportunities are available, like sports teams. If you want an asset that's not correlated, sports teams have done well in every market and every environment we've ever done. And they do better than the S&P. So I worked for a lifetime. I have those 5 rings back there, those all championship rings from different sports where I worked with a team, and some of them now I own. So I own a piece of the Dodgers, I own a piece of the Golden State Warriors. It's the most fun experience you can imagine. It's something you really enjoy, but also the returns on average across all those sports are 14% compounded, not 10.7. And you own a monopoly. You own a business that's a legal monopoly. And who are your customers? Fans. That comes from fanatics that are multi-generational. And now they're not just sports teams, the entertainment value. I'll just give you one example. The Dodgers. My friend Peter Gerber bought the Dodgers. He paid $2 billion for the Dodgers, 2.1 I think it was. And everybody in the news is saying, no one's paid over $1 billion. This is insane. So I said, Peter, I know everybody's saying you're nuts. I know you're not nuts. You're one of those sly, sophisticated guys I know. What do you know? What are you going to do here? Wait 3 days. I want to make the announcement. Then you call me. We'll come over and celebrate. He announces 3 days later. If you own a sports team, NBA, like there's 32 teams, if I remember correctly, you get 1/32 of all the media coverage that's done nationally and internationally. It's huge. And the NFL, which is the first team to they were holding out. We just made a deal with them. We're now doing what they